Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main immediate pattern here since September 2024 had been, and still is I suppose, after a fashion, the breached September to December 2024 bear channel, currently 1788 to 2074. That's highlighted in dark blue on my daily chart. This pattern has achieved its primary downside target mid-January, and its secondary highs reached target about a week after the primary target. Interestingly, the move down to the secondary target and back up again formed another new pattern, one which I'll discuss shortly. However, before that, I'd like to highlight again another larger long-term pattern, and that is the breached November 23 to September 24 bearish Andrews pitchfork, highlighted in bright green on my daily chart. This pattern, as I said, had been breached, but 2 weeks ago prices turned back down into the pattern, such that we are today in between the overhead upper time, currently at 1972, and above the middle time below, currently at 1616. Now, the recent action, especially since mid-December last year, has revealed another, newer pattern that had also been breached in early February, simultaneously with the upper time. This is the one I spoke about earlier. I said 4 weeks ago about this pattern, I quote, "This is a possible latent reverse head and shoulders pattern, but one that is not well defined, hence not worthy of the name of a reverse head and shoulders pattern," end of quote. Well, since then, this pattern has matured and we had a real reverse head and shoulders pattern, but not a reverse head and shoulders bottom, but a reverse head and shoulders continuation pattern that made a false break higher at the end of February. At the start of last week, with changeover, prices gapped even lower, and we saw a test down to the 50% absolute Fibonacci line for the 21st century, at the key 1809 level, as well as the dark blue breach lower bull channel line. This was, even to an untrained eye, a huge move back down, and as a response I drew last week a bright pink late September 24 to mid-January 25 bearish Andrews pitchfork to try to make some sense of it. Right now we're just underneath the middle time, currently at 1861, and just above the 50%, just above the middle time at 1861, and just above also the 50% Fibonacci line for the April 20 to November 23 move at 1859. Indeed, last week could be said to have seen the market on a closing basis called between the pair of 50% Fibonacci lines at 1809 below and 1859 above. This week looks like that situation has come to an end, as prices test up to the combination of the pink middle time and the 50% Fibonacci line overhead. Okay, so in an effort to get a handle on what further technicals were operating here, I went back to my annual commentary last week and looked for this year and looked at the monthly chart there, and I saw that the bright green Andrews pitchfork, despite the breach topside, is still the dominating pattern, along with a double top and Adam and Eve type that had been constructed throughout 2023, and which had already reached the primary target 1880. Leaving live a still as yet unfulfilled, harder to reach secondary target down at 1630. This longer term pattern is one I choose to watch, and I'll see how it develops. Ice Europe white sugar in London. There are now 4 features to bear in mind here on this daily chart. First is the obvious late September to date descending expanding wedge pattern, currently 417.80 to 536.5, highlighted in purple on my daily chart. This pattern has more than the requisite 5 touches, but was severely tested on the top side over the last few weeks, though prices last week dipped back down within the pattern, though not excessively so. The second is the January 24 to date downtrend, currently at 553.5. highlighted in bright red on my daily chart. It effectively capped any rises since its start, most recently 2 weeks ago. The third is the April to June 2021 head and shoulders neckline, below the market, currently at 487.80. This had been breached in January, but it seemingly still has some resilience, and the late January rise was seen, well, this uptrend has been one of the influences. that turned prices higher. Fourth, the now flatlining green short medium moving average, currently 517.40. This capped prices in the past, but this last week it has been part of a zone of support further down. It's been a zone of support. Now further up we have the mauve medium moving average, currently at 533.10, and a little further above that the gold long moving average, currently at 541.90. These were the start of resistances ahead of the upper trend line of the previously breached and now possibly repaired purple descending expanding wedge pattern, which is further above the market. Okay, so those are the main features of this market. Let's now look at what we have going on right now. Now, 2 weeks ago we had a weekly key reversal down that punched down further last week all the way down to the green short medium moving average, as well as the lows of September 2022 at 517.80 and October 2022 at 514.5. However, these three supports held, and by late last week and into this week prices have started to move back up, such that looking to challenge the declining mauve medium moving average above, which we're doing right now. Further back upwards is fine, turning back further up upwards is fine, but tackling all these highlighted resistances above, well, that is a different matter. They did not act that well as supports on the way down, and arguably they may not act that well as resistances on the way back up. But please bear in mind, the market was capped 2 weeks ago after a lengthy move higher since mid-January, so I wouldn't rule them all out just yet. Sugar white premium spread. Last week the market continued its break up and out of what was originally a descending wedge pattern that developed into a big bear channel, though last week's combination of another hanging man, but also a bearish engulfing pattern and a weekly key reversal down, well, that has tempered the rally and made the market look down from its heights, and this might just have caused a sense of vertigo to encompass this market. Overhead we have the twin notable 50% Fibonacci lines, the July 19 to September 22 move at 128.75 and the August 2021 to September 2022 move up at 131.25, plus the June 2020 high at 134.25. Now these together seem to, as I said earlier, have tempered the move higher and introduced some bearish hesitation into this market. However, from the original large descending wedge pattern seen in 2024, we still have the topside targets for this break and move higher, revealed 2 weeks ago. And that's of a primary target X at 137.5, which is above the immediate overhead resistances, and a secondary hard to reach target X1 up in the 154.5 area. So are these targets achievable? Well, yes. But there is a question mark hovering over all of this, prompted by the combination of the previously mentioned 50% Fibonacci lines plus the June 2020 high and a congestion area we have overhead between 128.75 all the way up to 153 even, which will make target X perhaps seem hard and target X1 further up just that much more difficult. Last week we were just about to enter this congestion area, but in the end prices faltered and we even dropped down to the gold long moving average below, currently 111.5, to gain some support before finishing back up, but still below the previous 2 weeks closes. Apart from this gold long moving average, we really don't have that much below until we start approaching the 85 even zone.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.